Well, it's nearly March, if you can believe it, and that gives us a quick chance to review the market performance so far this year. Recall that January was a modestly positive month for the TSX, up about 0.33%. And coming into this trading session, the Canadian benchmark was up closer to 1.5%. For the current month. Meantime, in the United States, the S&P 500 is up nearly 5% this month after a gain of more than 1.5% in January. So we wanted to know, is that a good sign for the balance of the year? Well, CFRA research looked historically at what happens in the U.S. after gains in both January and February. There have been 21 such examples going back to 1971, and literally every year for the S&P 500 during which that occurred has netted a positive year overall. Now, there were a couple of examples where in the final 10 months the stock market pulled back, but the key word there is a couple, just 2 years out of 21, 1987 and 2011. So said another way, 90% of the time when the S&P is up in January and February, it continues to climb for the rest of the year. And the average return in those 10 months that follow January and February is 13%. Now, by comparison, I looked back at the last 10 examples in Canada where the TSX rose in the first 2 months of the year. And in that smaller sample size, the Canadian benchmark was still higher in the majority of the years where that happened, 80% of the time to be exact, looking back at the 10 years since the year 2000, when the TSX was higher in February and January. There were examples, absolutely, where come March to the end of the year, you no longer saw positive performance, but 60% of the time, there were additional gains in those 10 months that followed